LeadScorz.org.
The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're going to be talking about money. You know, I have a program today. I have something about an event that opened in Seattle. And I think to really appreciate it and appreciate the impact it might have, you have to go back 140 years ago. I think there's a background that makes a lot of sense that really will give you some insight into this event that's going on in Seattle. And I think it has some application to investments as well. That's coming later in the program. I am hoping that I have a really good guest today. So far, he's not here, but we'll see. Hopefully, we have a long time to go. We have some time to go before he arrives. And if he doesn't arrive, I've got a lot of things to say. Actually, I've got a lot of things to say all day today. So let's get started. You remember 2008, 2009? You know, that's now been 8 years ago. In some ways, it seems like it was a long time ago. The memory is kind of dulled. It's kind of shifted out of the memory. And in some ways, it seems like it almost just happened. It seems like some people are predicting that it's going to be back again and back again soon. Probably not, at least not for another 10 or 15 years. And I think we'll see one of those events happen again, but I don't think it's going to be anytime soon. But I want to take you back. Remember, stocks plunged to 6,600. 6,600 in March of 2009. The market started down in 2008. It continued down. Lehman Brothers went down in September of 2008. I happened to be in New York City, actually, not anything to do with business. We were going to every baseball park, and we happened to go to the Yankee Stadium and Shea Stadium to see the old stadiums before they were torn down. But our hotel was just a block away from Lehman Brothers, and so I got to watch, from the outside at least, I got to watch that whole thing as it came down. It was almost terrifying. I'd been preparing, of course, for a credit crunch, but had no idea we were going to be in a crisis. Coming back on the airplane, I said to my wife, we're not in a credit crunch. We're in a crisis. But, you know, it was a white-knuckle time. It was a time of tremendous fear. Some were predicting, there was at least one prognosticator that was predicting the Dow would continue going down to Dow 1000. It was a horrifying time. It was a time in which people saw their investments sink. Their investments intended for retirement were plunging. Their investments intended for college education's plunging. And during that time, you had people replanning their college. You had people thinking about working longer. You had all sorts of things going on. But, you know, as things plunge down, either you're going to go to zero and it won't matter anyway, or you're going to recover. You know, my standpoint, I'm a strategic investor. I look at the fundamentals. But we're seeing more and more a market that's driven by the tactical side. And, you know, let me kind of explain how we got there. You know, for me, the way I think is that when you're buying a stock, you're buying a piece of a business. And what values that business is what that business is going to earn. It's, if you're selling a business, you look at the earnings, you look at the quality of the assets, you look at how well the business is doing, what the competition is like. I think when you examine a stock, it's the same kind of analysis. Whether you're buying or selling a business, buying or selling a stock, it's the same kind of analysis that takes place. That's the strategic approach. The technical approach says there's nothing that you have to look at except for the price and the momentum. Is it going up? Is it going down? Is the volume increasing? Is the volume decreasing? They make all sorts of stochastic charts, candlestick charts. All those are candle charts. All those things go into the technical side. You know, that's where we're seeing more and more. Cerulli did a study a couple years ago and found that over 45% of financial advisors were switching and using tactical approaches rather than strategic. There's a reason for that. Having gone through 2008, 2009, it was a very, very painful time for most advisors and for their clients, especially for their clients. But advisors looked at this and watched accounts go down. It was almost daily down, 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 down. That's the process we were going through. And the idea comes up, if you can avoid the down times, you can avoid all those losses. You can sleep well at night. You don't have to worry about retirement. You don't have to worry about all those times. And so more and more people began to use tactical, looking at the charts, looking at prices, looking at what was going on with the stocks. It didn't matter what the company was. The whole story theoretically was told in the price movement of the stock. Good news would propel the stock up, bad news propel it down. And the volume, the more people that were piling into the stock, the better it was. The more people that were bailing out of the stock, the worse it was. Now, I think in looking at that and looking at where we are, there's a very, very big difference in the approach of a tactical and strategic advisor. Jackson National Life did a survey of financial advisors, and they found that 75% of advisors felt that they were outperforming the market. They were doing better than the market was. 75%. Now, the data goes back to 2010, 2011, so things may have changed somewhat, but the idea was that financial advisors were beginning to feel good again in 2010, 2011, thinking that they were doing very well. But Cerulli, this other company that does studies of investment advisors, found that, in fact, the returns for the advisors were 4% cumulative for the 2 years versus the Standard & Poor's that was up 17%. We were up significantly more than that, but that was an unusual time as well. The things that were learned during that period of time was that modern portfolio theory didn't protect portfolios. The idea of asset allocation didn't really work. Asset allocation was one of those things where you believe that by investing in asset A and B and C and D, that if one goes up, if one goes down, another one will go up. So that it all balances out, and the total picture is that everything increases. But what we went through in 2008, 2009 is when one thing went down, everything went down. It was an unusual time, but it was a factual time. It was one of those times when we saw the normal rules, what had been normal for a long period of time, didn't really apply. That was 2008, 2009. But there was more that has been going on since that time. When I first got into the business, I got into the business in 1986. And when I started, there was the New York Stock Exchange, the American Exchange, and you had some smaller exchanges like Philadelphia, you had Chicago, and you had the over-the-counter market. And computers were just really beginning to be used. Prior to computers, it was a physical time. The New York Stock Exchange, you've seen the pictures of the people on the floor of the exchange and see people gathered around. What's happening on the New York Stock Exchange? What happened in those times prior to the computers is it was an actual auction exchange, so that someone would buy a chair on the exchange. That gave them the right to make the books in a stock, an IBM, a General Motors, a AT&T, and they were able to run the books and take in orders and balance the orders, the buys and the sells. But when you had a big order for several million shares, 10 or 12 or 15 million shares, and you had someone else that was putting in a sell for 100, it really didn't balance out. And so it became a third party off the exchange when these deals were done. If somebody had a big thing to do, it was done off the exchange. And so you began to develop more and more trades that were being done away from the exchange and being done on a third-party basis. And more, it became a computer run. You began to have market makers who could make a market in a stock in Seattle or Atlanta or North Dakota. You didn't have to have a whole lot of requirements, and that whole NASDAQ system began to grow out of the over-the-counter market. That continued until you begin to get more exchanges, more than the American, more than the New York exchange. You began to have other exchanges, and that's had a significant impact on the trading that's going on. We have over 13 exchanges like the New York Exchange, and most of those exchanges are driven by computers rather than physical. We're going to come back and talk to this. Don't go away, because it does have an impact on what's going on. My guest is here. We're going to have a very good interview, so stick around for that too. And I'll be right back.
For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So we've got a lot to cover. My guest is here today. You'll hear from him very shortly. And there's an event in Seattle that, you have to go back. There's some background that goes back 140 years. It's something worth hearing, and it may have some application to investment. That's coming later in the program too, but I want to pick up where I left off. I was talking about the changes that are going on and had an impact in 2008, will continue to have an impact going forward. There used to be a New York Stock Exchange, mostly done physically during the 50s and 60s. As computers came into existence and computer trading began to go, it's begun to change. It has changed. Now, instead of a few exchanges, we have 19 actual exchanges, and more to come. And over 70% of the trades that are done today are done by computers. 70% of orders, not orders, 70% of the trades that are done by computers. I didn't really realize the impact of that until I read the book, and now I've forgotten the name of the book. That's terrible. Anyway, it talks about the impact of what was going on with the computer exchanges and how computerized trading has impacted what's going on. So when I was beginning to trade, I would trade 100 or 200,000 shares for clients. I would put an order in at $30 per share, $30.10, whatever it might be, and it would usually fill at that price. But I noticed that what was happening was I would put the order in at $30.10, and 100 shares would fill, and then the price would move up so that I would have to pay 10 or 15 or 20 cents per share more to fill an order. And the same thing happened on the way down. That was happening because of flash trading, which is the name of the book, by the way, flash trading. Remember? Yeah, get to the point where. And you ended up with what was really happening. If you had a 100,000 share order in days prior to 2008 or 2007, in those days prior to that time, you'd put in an order for 100,000 shares, and it might be distributed 10,000 shares to 10 different exchanges, but all essentially at the same price. But with computerized trading, the flash trading that was taking place, what would happen is the BATS exchange is normally the fastest. The trade would go into BATS, 100 shares would be filled. The computers would detect that there was an order behind it, and it would automatically go in prior to your orders entering the other exchanges. They had such a fast reaction in nanoseconds. In that period of time, they would buy up the stock that was available and then sell it back to you at a higher price. It's been a question that's been raised about the whole idea of this front running, because essentially it is front running. And not only that, but when they place orders, in order to make the orders fill, they're ordering in hundredths of a cent. So that if they want to buy the stock and they see an order come in at $30.10, they'll place an order for $30.1001, $30.1002, orders at $30.1003. And what happens is, if you look at a time like February 8th of 2010, there was 1.24 billion shares that were traded that day. But there were over 89 billion orders that were entered on that single day. 1.25 billion shares traded, 89 billion orders entered. What happens is they enter so many orders at such small increments, but as soon as they begin to get fills on those, they cancel the orders. So there may have been 1.24 billion orders that were filled, but there were 87 billion orders that went unfilled, that were not only unfilled, but were canceled before they could be filled. It's made it extremely difficult for those people who are trading, and yet this whole idea of going with tactical trades has swept over this whole market. And we're starting to see the impact of it because we're seeing a significant separation in value stocks and momentum stocks. Momentum are those that are pushed by the technical people, the momentum players, the tactical investors, and those that are invested by value. Eventually, all of that caves in. Eventually, the momentum stocks will reach a point where they suddenly cave in, and all those people who rush to buy will be rushed out of the stock. There's very few who actually outperform the market. Eugene Fama got the Nobel Prize, shared the Nobel Prize in 2013, showing that fewer than 7% of money managers actually do as well as the market when their fees are considered. Fewer than 7% earn their fees. That's a really small number. That means that 93% underperform. And that's something I believe will continue. There's a right way and a wrong way, in my opinion, to do this. But that's my take. And everyone has to make their own decision on where they go. I want to talk to you about my guest today. I want to introduce Pat Murphy of Vega Performance Marketing and LeadScorz. Welcome to the program, Pat.
Hello, Mike. Thanks for having me.
So let's start with your background.
Well, I've been in the technology business since 1984, primarily developing business-to-business applications to help businesses improve the efficiency and operation of their business operations, and mostly centered around digital marketing and marketing support.
It's been a big market and growing.
Yeah, and it's changed quite a bit, as you might imagine, over the past several years. Currently, our focus is on applying big data, predictive analytics to the marketing efforts, and LeadScorz is the company we launched earlier this year as a spin-off of Vega Performance Marketing, is really focused on applying big data and predictive analytics to medium-sized businesses that heretofore really haven't had the wherewithal to take advantage of the new technology and the new science of data management.
So a couple things. First, define what big data is.
So people have different definitions, but my definition is the ability to use computer technology to aggregate data resources from across the internet and various companies and entities that gather data on consumer activity or business activity. It could be purchase data, it could be public data, it could be data that's sourced directly off internet traffic, from social media, from content sites, and so forth. And that data is aggregated into huge repositories, and different data repositories are synced into a platform. So if I want to find out more information about an individual or about a company, I can very quickly, in nanoseconds, aggregate hundreds, if not thousands, of data bits about that individual.
And so that leads us to predictive analysis.
Yeah, predictive analysis is, well, the way we do predictive analysis is using a concept called machine learning. And machine learning is a way of using very, very fast computers to handle huge, disparate databases to look for patterns across thousands, or not millions, or trillions of bits of data. And that machine learning helps us develop predictive models so we can predict the behavior of an individual or perhaps of a company in terms of their buying behavior or inclinations towards a specific product or service, and therefore to target advertising towards them.
And so when you talk about LeadScorz, and before we even get to that, with LeadScorz, you're looking for companies that are in what size range?
Well, it's not the size of the company doesn't matter as much as the volume of sales leads or sales activity that they have based on the marketing they're doing. But typically it's a mid-sized to larger company, probably in the $10 million annual revenue range and above. What the metrics we look at is how much they're spending on their digital marketing, how many sales leads they process in any given month, and how much help they need in prioritizing those sales leads.
You know, it used to be that companies would advertise on TV or advertise on the radio or in the newspaper, and people would walk in the door, but you really didn't know who they were. You didn't know much about the person. You had to go through the qualification. But what you're saying is you're determining who those clients are and actually taking a proactive approach.
Yeah, it's really about helping the merchant better define and target their audience and target their advertising to be more efficient in their operations. It's really about cost savings. The less they have to spend on marketing to target the right audience, the lower their costs are and the lower their prices can be. And big data is sometimes a scary word to the consumer, but it's really a helpful technology. It helps ensure that they're served advertisements or presented offers that are more relevant to them. And so it's really just about better understanding your customer so you can better serve them. And it works very, very well. LeadScorz is a relatively new application of cutting-edge technology, again, that's helping provide solutions to businesses that they really didn't have the capability to do before. and we've just made it easy for them to do that.
We're going to come back and talk more about LeadScorz and talk about how it might apply to your business, or at least how you'll learn what's going on in terms of marketing. Don't go away. I'll be right back.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Pat Murphy, the CEO and founder of LeadScorz. And we've been talking about this whole idea of big data, determining who your clients are and how you can better serve. So I'm going to pass it back to you and tell us more about the advantages of this type of marketing.
Sure. So LeadScorz is really about managing the production of marketing efforts, the leads that come into a business, whether they be consumer leads, might be for a university that's trying to recruit students to online courses or on-campus courses, might be a financial services firm trying to sell financial services to consumers, could even be people that are selling mortgages or any other considered purchase a consumer might make. And the advantage is being able to use that company's historical data. So the customers that we look for are those that have a pretty large repository of historical data in their customer management system, what we call CRM systems or marketing systems, to where they can provide anywhere from 10,000 to 100,000 or a million leads of historical interactions, including people that bought and people that did not buy, or companies that bought, companies did not buy. And we can use that history to then append thousands, hundreds of thousands of data bits from our big data resources to each one, and then we put it through a scoring model that tells us which signals or which patterns within that data lend to predict which outcomes are going to occur, who's going to buy, who's not. And it's not a black or white or 0-1 sort of scenario. It's really looking for a relative quality score across the population of those leads. So then the company can take that information and prioritize their sales team, or the way that they present these leads to their sales team, and save money and time by focusing on the most relevant leads. Our tagline is "Your best leads revealed," and that's what we do. We use big data and this modeling technology to give them a score, typically between 1 and 100, that helps them identify their most promising leads.
As you're talking about this, it reminds me of something that's an analogy, and it's not completely correct. But being on the radio, I was approached by a radio station out of San Francisco who wanted me to do a radio program there. And they wanted me to sponsor my own advertising. It was the same radio station that broadcast the San Francisco Giants and the San Francisco 49ers. It's a sports radio. They have a very, very wide audience. And the price to advertise is very, very high. And I thought, that's a scatter, that's a shotgun approach, because of all the people that are listening, there's only a very small segment who would be applicable to what I'm looking for. And my price per potential client is going to be enormous when I think about that.
Yeah, we call that effective cost per action, or what is the bottom line cost of those people that actually buy relative to the amount of money you're spending on marketing to drive the number of leads it takes to flush out that 1% or 10% of people that will actually buy. And let me give you an example. We had our first client that we put on this platform was an online university based in California. They bought anywhere from 5,000 to 10,000 leads a month through their marketing or through direct purchase of leads from third parties. Our platform showed them that they could literally ignore half of them and still and increase the number of conversions, number of enrollments that they got out of their leads just by applying this predictive technology to score those leads. And it's just applying science to data is really all it is.
And with that example, I'm assuming if they bought 10,000 leads and only 5,000 are applicable, all the money they wasted on the 5,000 which were not good leads was completely lost, and they could have applied more resources to the 5,000 that were valid.
Well, and that speaks to the other benefit of deploying our platform. It's not just about prioritizing the leads that come into the sales funnel, as we call it, but it's then using that same data, the same analytics, to point back to your marketing tactics, and it tells you where your return on investment is coming from, where the better return on investment is with regard to the marketing spend that you're applying to create those leads. Most companies use multiple channels to generate leads: social media, search media, Google, Bing, display advertising, email, etc., and other types of events. And they need to figure out where they're getting the return, and then to optimize their spend to put their money where it's best utilized. And then they can improve the overall quality of the leads that they're feeding into the system in the first place. So it really serves two purposes. By using big data, you can both prioritize your sales funnel, and you can optimize your marketing spend.
And, it's something that's really coming for most companies. And for those companies that aren't using it now, their competitors are.
Absolutely. And most very large companies, your Fortune 1000 companies, are doing this to some extent. They may be using more rudimentary application of technology, what we call rules-based scoring, or they may use simple regression analysis models. The big sea change in this industry is the advent of these companies like our partner, I'll mention them, Versium Analytics out of Redmond, Washington, that have amassed very, very powerful data gathering and data management platforms. They host in the Microsoft cloud. We happen to host in the Amazon cloud, but it gives them the ability to do extremely fast calculations. Their database has over 1 trillion records in it today. And it's the advent of the ability to quickly take advantage of that by applications like LeadScorz that's new to the marketplace. So companies, yes, they should get on the bandwagon before their competitors get out in front of them.
And, this is something that has come probably in the last 5 years or so?
Or less even. I think the first competitive company, I started developing this product about 2.5 years ago, the early concept. And at that time, there were really 2 other companies. One had been around for about 8 years, the other one about 6. Today, I count about a dozen companies that have jumped into this space.
And large companies have begun to use it. You read about some of the things that have happened with Target and some of the other companies. But what your advantage is you're making it available to the medium to smaller size companies who, in some cases, are competing against the big companies.
Yeah, absolutely. And even small nonprofits. We've done a small nonprofit foundation, fundraising foundation for a hospital in Eastern Washington that had a database of only about 6,000 donors, and we helped them expand that a bit and target it. But they implemented this whole system for under $10,000 a year, which is actually quite affordable. Where larger companies that have used this in earlier years, they spend millions of dollars to develop these capabilities. We're benefiting from the platforms that partners like Versium, in our case, have developed, and we've just built an application to bring that down into the mid to larger enterprise.
If someone wanted to get a hold of you and wanted to follow up and investigate and see how it could work for their business, how would they do that?
Well, the best way is go to our website. It's LeadScorz.com. That's Scores with a Z, LeadScorz. Or they could call our offices at 206-899-4468 and talk to my sales team. And we'd be glad to talk to anyone. We're early on in this industry. We're discovering ways to improve what we do every day, and we're always looking for new ways to apply it into different vertical markets. So if you're a financial services company, a university, consumer products company, the only requirement, again, is that you spend a lot of money on marketing or a fair amount of money on marketing, and you have a lead database that you'd like to do a better job of prioritizing and optimizing.
So say again, the website, the phone number.
It's www.LeadScorz.com. The phone number is 206-899-4468.
Thanks. Very, very interesting and very, very important for many companies, especially the smaller to medium-sized companies who are not using this because their competitors are.
Absolutely, and we look forward to what the future is going to bring, and we think it's a very promising sector. And Mike, thanks again for having me on the show today.
You're welcome. So I want to convert and talk about an event that's going on in Seattle, opened last week, and I think there's some information which is fun, that is interesting. But to understand it, we have to go back to 1876. There was a legendary medical professor in Edinburgh University, name of Joseph Bell. And there was a new group of students that came in to Dr. Bell's class. Dr. Bell demanded that they observe, and he pounded this theme that observation and deduction was very, very important. He said that you had to look for very trifling things to understand what was going on. Now, this is a medical professor talking about medical things. And the new students were all, sure, yeah, right. They were young. They knew what was going on. They knew it all. Things haven't changed that much in 150 years. So Dr. Bell called his first patient. And the man walked in, and I'm about to tell you, but we're coming up to commercial break, so we'll just have to wait for this. It's important to understand. Dr. Bell, Edinburgh University, new group of students, very skeptical students, but what they were to learn had an impact, and it had an impact on an event that opened last weekend in Seattle. Hang with me. I'll be right back to talk about what that event was and why that happened in Edinburgh.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I started talking about this background to this event that opened in Seattle last week. It goes back to 1876. Legendary professor Dr. Joseph Bell, Edinburgh University. And if I was really good at speaking a Scottish accent and do it the right way, but I'm not that good. I just talk in my same monotone. But Dr. Bell talked, as a new group of students came in, he talked about the importance of deduction and deduction reasoning and the importance of absolute observation, even the smallest trifles. And as the students, very skeptical, watched this whole thing, Dr. Bell called in his first patient, and according to published reports, the man walked in, he stood, and Professor Bell walked around him slowly once, and then walked around him slowly a second time. And Dr. Bell says, "Army, recently discharged? Probably Scots Highland." "I," said the man. See, that's a little bit of my Scottish accent. "I?" Not very good, sir. "I, sir?" Dr. Bell observed and he said, "Non-commissioned officer, likely in the West Indies, perhaps Barbados." "I again," the man said. Quite surprising to the students because, the patient was confirming every guess. Professor Bell said, "Okay, this is what happened. The man appeared courteous and respectful, but he didn't remove his hat. Members of the Army don't do that. So likely he was recently discharged from the Army." Now, the gait and the tone showed that it was like he'd learned that in the Scottish Highland, and thus the Highland Regiment. And he had a little elephantitis evident on his arms, so that meant he probably was stationed in Barbados because there's been a recent outbreak of elephantitis there. So you can imagine the impression on the students. They were impressed. And one particular student was absolutely odd. Now, every few years, students observed, and every year they were fascinated. And when they had a question, they would go to see Dr. Bell. And this one student went to Dr. Bell's office, and when he knocked on Dr. Bell's door, Bell, without ever looking up, said, "What are you worried about?" And the student was a little startled, and he said, "How do you know I was worried?" And Dr. Bell, still not looking up, said, "You knocked 4 times. Timid people knock once. Most men knock 2 to 3 times. Someone who's worried knocks 4 times." Time and again, the students watched Dr. Bell make amazing deductions from simple observations. And this one student vowed he would never forget Dr. Bell, and he never did. And you know what? We never will either. That student, made sure of it. Because after graduation, that student hung out his shingle. He hung out his right to practice medicine. But whether there was an outbreak of health, or whether it was hung in the wrong place, or whether he just didn't pick up many clients, he didn't have very many people that came to see him. So he began to write. And he chose a detective. And he based the detective on Dr. Bell. And for a sidekick, he chose a curious, but not so observant, doctor like himself. And thus, Arthur Conan Doyle, even as Dr. Watson, stood in the shadow of his hero, the great Dr. Joseph Bell, who he called Sherlock Holmes. And the Sherlock Holmes exhibit opened this last weekend in Seattle. And now you can go, because now you know the real story behind the creation of Sherlock Holmes. Observation and deduction is very, very important. I remember when I was younger and you had the Soviet Union and the United States, and there was a race. And it wasn't the Olympic Games, but it was some sort of race where the Soviet Union and the United States were competing in a track race. And the U.S. athlete won, and the Soviet came in second. But in those days, the press, like it's becoming again, controlled by the government, the press put its own slant on that race. And it reported that the Soviet runner came in next to first, and the American runner came in next to last. It's deducing. If you didn't know there were only 2 runners in the race, you'd think that the Soviet came in very well and the American came in very poorly, when in fact, the Soviet runner lost to the American. I think in investment, we see a lot of those kind of things taking place, where deductions, where people are talking about things, but you don't know the facts. I happened to be in New York City, and we did a walking tour of Soho, Little Italy, and Chinatown. And our guide was saying, as we were jaywalking, of course, was saying that only 20% of the fatalities are from people who are jaywalking. 80% of fatalities from people that are killed in the street are pedestrians who have the right-of-way. Now, the deduction is, if you want to think about it in one way, it's much safer to jaywalk than it is to have the right-of-way. The problem is, when you really think about it, it's in numbers. That 20% may represent a very small number, and the 80% is a very large number. So if you have 100 people who are pedestrians with the right-of-way and 4 get killed, but you have 8 pedestrians or 8 jaywalkers and 2 get killed, there's 4% of those that were in the right-of-way and 50% of those who were jaywalking who were killed. It's figuring out and deducing, taking the deduction to the logical thing and not looking at the spin, looking at it in realistic terms, which gets you to the right investments at the right time. And even then, I can tell you, most investment advisors, most money managers are wrong half the time. That's a lot better than baseball players who are only right, only get a hit 25% of the time. So being right 50% of the time is not bad. Next week, we've got more things coming. We've got a lot of things to discuss, so join me next week. And some of these programs are replayed, I believe, on Saturday evening at 6 o'clock. So if you miss part of this, you can pick it up tomorrow night at 6 o'clock on this station, KKOL 1300 AM. You can also find it on our website. It's also on iTunes. We're in a lot of places. So have a very great weekend. Go see Sherlock Holmes. I haven't been, and I don't know where it is. I just know that it's in Seattle. Google it, and you'll find it in Seattle. Have a great weekend, and I will be back next Friday to talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
When I was little, we could talk about anything.
I still want you to talk to me.
When I was little, you gave me hugs.
I still could use a hug once in a while. You're my parent, and I'll always need you.
No matter their age, your children never stop counting on you. Visit parenting.org for helpful resources or call the Boys Town National Hotline